I'll show you how I got my partner to buy a brand new apartment for 130 grand, less than price on settlement, how she got an absolute savage rental return, and how she managed to save almost half her stamp duty bill. I'm Simon Atkins, your brand new apartment specialist, helping you buy your new apartment in Perth. Many people from here, interstate and overseas, are looking to invest in our property market in Perth right now, and the market is not going to be slowing down anytime soon due to a number of factors talked about in my last Perth property update. So why buy a rental apartment, and how do you profit from that purchase?
So
many people believe
take a look at this
apartments
graph
don't increase in value as
looks.
much as homes, but apartments allow you to do some things that houses don't. But let's first look at this idea that apartments don't increase as much as houses. So let's take a look at this graph and see how this looks. As you can see, apartments have a lower median price than houses, i.e. they're generally cheaper. You can see as the market ebbs and flows that they follow a very, very similar pattern. So I've invested in homes and apartments over many years, and I can say I have never seen the apartments grow less than the houses. In fact, I tested it over a period of a 10-year time frame, and what I found out, that it wasn't really the house or the apartment that drove the growth. They weren't really responsible for the growth. It was the location. So that's a key takeaway. It was the location that was responsible for the growth. This completely changed how I invested, and I also found out from the experiment something else. The apartment, although it grew at the same rate as the house, because they were in the same suburb, another key point, the apartment cost me less because it had a stronger cash flow. Okay, so the things that apartments are beneficial for over houses are that you can buy in blue chip suburbs at a fraction of the cost of a house, of course. And for investors, that's great, because if you've already got a house, trying to buy another house is not necessarily that easy, a much more expensive property. So you aren't paying for excess land that doesn't generate cash flow return. I can explain that a little bit further. So if you just had a block of land and you bought that block of land as an investment, you wouldn't have any cash flow from it, okay? Because the land doesn't generate any cash flow. You can't depreciate anything on it, so you can't write anything off. It's just a piece of land sitting there, and if you've got a loan against it, you're just paying the outgoings for that loan. Whereas if you take that piece of land and you put a property on it, a house on top of that, then that property is the thing that generates your cash flow. It also allows you to depreciate the property itself, so the construction of the property, and this is true for houses or apartments, and the internal fittings and fixtures of that property as well. So as an investor, that's what you want. The cash flow is there, it's the lifeblood, it's the thing that supports you during you holding on to that investment. So in addition, apartments are now outperforming houses, and it's set to continue in Perth. 75% of the apartment market is either matching or even outpacing house price growth, according to Newstar and Hotspotting. Yields are also higher than houses, and that's nothing new. In other words, apartments are generating higher cash flow returns for you than houses, which is not unusual due to the lower land content. So according to REWA, the median house price, just to underline this point, the median house point is $805,000 in Perth for a house, and the median apartment price is $560,000. So there's a bit of disparity there between the median price of a house versus apartment. Yet the median rental return on a house is only $690 per week versus $650 per week for apartments. So we can see a large disparity there based on a much lower income returns for houses rather than, of course, for apartments. So the other thing is new apartments also generate higher deductibility. As I touched on before when I was just using that land example, you can't depreciate land, and any new property also manages to give you the added benefit of being able to write off all the fittings and fixtures within that property. Okay, so all of those things give you a really big cash flow boost in the first 5 years or so. They really pump up your cash flow during that period of time, being able to claim all these things. So to maximise the deductibility, and the quality of tenant, a new property can make a lot of sense. Plus, the cash flow is not just what comes in, it's also what goes out. So you need to be thinking about that. It's just not necessarily about yield anyway, it's about what comes in and what goes out. So new property absolutely minimises expenses and repairs in terms of maintenance and so forth. So there's obviously less money going out. So where does it make sense to buy an apartment? In locations where apartments work best is the obvious answer, and that's in hubs. So hubs are locations such as, say, Leederville, Subiaco, and centrally located around, generally areas located around or close to the CBD, not in the CBD, but around it and within good access to it, where someone can live a lock and leave lifestyle, have access to great amenities such as local restaurants, bars, boutique shopping, and if possible, it's a great idea to be close to a train station as well, because that will have more effect over time as we get busier, more people here, and roads get more congested. So I would also recommend a high median house price suburb with these attributes, which these types of locations, of course, normally are. So these are the types of areas that can prove to be an excellent apartment areas that have high demand, not just from resale for other buyers when you sell it potentially down the track, but also from tenants, of course, which are going to be paying you an income. So what about a strategy around this? So I've got a strategy that's worked really well for my partner. It's working really well in the current market and will continue to work well for some time yet because of the market that we're in. So you can get a new build rental property at today's market value without having to actually pay for it, in many cases for 2 years or more. So that's the first advantage. If you're not ready to buy something yet, you can still put your foot on something. So that's a real advantage in a market like this. You are then able to control something without the ownership, which means you can let the market do all of the heavy lifting and then settle on a new rental apartment with an increased value by the time settlement comes around. So that's a huge bonus. It's like buying a property at a substantial discount today, in today's money, if you were to just go out and buy something now. So the deposit that you put down will mean that you control that property and settle at a future date. So you have, as I mentioned, you have control without full ownership, and that's super important. So the second thing is that buying an off-the-plan property will save you considerable amounts of stamp duty. And nobody likes paying stamp duty because it's dead money, it just goes to the government. And it's, for an investor, it's not tax deductible either. Well, it's not tax deductible for anyone. It's just a hard cost that you have to pay. So in fact, you can pay zero stamp duty up to $750,000, 50% less stamp duty payable over $850,000, and it's a sliding scale just in there between $750 and $850. So huge stamp duty benefits there by buying something new off the plan. And this, as I mentioned, is something you don't really want to be paying, or as little as possible, because it's just a dead cost. So if you do buy an existing property, you'll pay full stamp duty, and if the property has been pre-owned, you'll have less deductible expenses due to the fact that it's already been previously owned. You can't claim all the fixtures and fittings if they've already been owned by someone else. So the third thing is that once you lock in the price, you stop it from being a more expensive purchase for you down the track, because when you actually settle on the apartment, that value has gone up. As an investor, that means although you've locked in your price to purchase the property, the potential rental yield against that property continues to increase while you're controlling that property, because rents are currently under huge pressure and increasing, and will do for some time. So instead of just waiting around until you're ready, when pricing has increased, you can stop the price increase by putting a deposit down now and finance it later when settlement comes around, and have a stronger rental return as well. So it's a double whammy there. So I've got a great example. I talked my girlfriend into doing this, my partner, a little while ago, and took a little bit of arm twisting, but I got it to do it. So let's look at the example that we did with her. I suggested that she purchase an investment off the plan in the Olive Street development in Subiaco. She put down a deposit to hold the price of that property, as I've mentioned, so she's controlling without buying. Okay, this strategy ticked all of the boxes that I mentioned above. So firstly, she locked in the purchase price and has substantial equity on completion as the markets continue to grow. Once she put a foot on that property, she saved herself plenty in stamp duty as well. She's massively increased the rental returns whilst the development was being built. So rental returns have continued to increase even though she locked in the price. So let's take a little bit of a look at the numbers just to see how this worked out so well for her. So the whole price when she put the deposit down was in October 23 for $520,000 on an apartment, brand new apartment. In September 2025, the price on settlement was $650,000. So they're just about to settle and it's worth $650,000. So an equity gain for her of $130,000. So she's got to love me for that, I would imagine. I think she hasn't really thanked me for that yet though. But anyways, normal stamp duty would have been $18,715 on that apartment. The stamp duty she actually paid was $11,696, saving over $7,000 in stamp duty. So another great saving there. And the rent, the original expected rent when she first held that property, put a foot on that property, was $600 per week. And now the rent's been assessed again now, and it's between $750 to $800 a week, which is a rental yield of 7.75%. So imagine buying a property with $130,000 in value without paying a cent off. And of course, the rental return too has exploded over that period of time. So this property will more than pay for itself. In this example, she purchased during construction, so the stamp duty saving was actually less. If she had purchased pre-construction, the stamp duty saving would have been another, it actually would have been $0 because the price point she's paid in, as there's no stamp duty payable. So the equity gain would also have been more because she would have she would have purchased earlier in the process when they were a little bit cheaper as well. So the key here is that when you buy into a development like that, once you have locked in the price, then all of the developers' price rises after that work in your favour because those price rises are increasing your equity within that development. So that's how you unlock the profit potential of new apartments. If you'd like to unlock the profit potential of your rental apartment for yourself, then contact me on the details right below the description here. And don't forget to like and subscribe my video. So here's my latest update for Perth. It will help you see why buying an apartment off the plan right now is such a great idea. I hope to see you next time.